Hi, I'm Christine Short, Associate Director with S&P Capital IQ Global Markets Intelligence. In this week's Lookout Report, we take a look back at the results for second quarter earnings season for S&P 500 companies. The second quarter earnings season is nearly over, with 446 companies from the S&P 500 reporting. As it stands, year-over-year growth has come in at 4.7%, a bit lower than Global Markets Intelligence predicted at the beginning of the season. Over the last 10 quarters, estimates at the beginning of the earnings season are on average about 4.7 percentage points lower than the final number. So far for the second quarter, the surprise ratio only stands at 1.8%. Most of this is due to big and unexpected misses from the likes of Microsoft, Google, and ExxonMobil. If those three companies had reported results in line with analysts' expectations, growth would be up to 5.8%, closer to the 6% mark we anticipated. Under that scenario, earnings per share would have hit $27.15. Currently, earnings per share is only at $26.87, still an all-time record for the S&P 500, beating the previous record of $26.71 set last quarter. Despite some disappointments this quarter, companies are still predicting a strong second half of the year. Thus far, 84 of the 446 reported companies have provided earnings per share guidance for the third quarter. Of those, 50 are negative, 22 are positive, and 12 are in line with analysts' expectations. This produces a negative to positive ratio of 2.3, meaning that for every 2 or so companies that have issued negative guidance, 1 has issued positive guidance. This is below the historical average of 2.4 and much lower than the trailing 4-quarter average of 3.6, a positive sign for future earnings performance. The last time the warning ratio was this low was for the first quarter of 2012. On the downside, while companies have been able to eke out some decent profit figures, they have been unable to replicate the success on the revenue side. Only 53% of companies have been able to beat top-line estimates, in comparison to the 65% that have beat on the bottom line. This certainly hasn't helped the growth rate, currently still in negative territory at negative 0.5%, which would be the first negative revenue growth rate we've seen since the third quarter of 2009. While companies have been successful at cutting costs, which is apparent from their bottom line growth, their dismal sales results illustrate that they are simply not growing. Despite low growth for this quarter, the sales picture for the balance of the year looks a bit brighter, with analysts expecting revenue growth of 4.6% in the third quarter and 3.9% in the fourth quarter, rounding out 2013 calendar year growth at 2.3%. Next week, earnings season slows significantly, with only 13 companies expected to report second quarter results. I'm Christine Short, and thank you for tuning in to this week's edition of the Lookout Report.